Let's see the next ratio within the concept of valuation ratios, that is the PE ratio, which is the price to earning ratio. Here again the price is the market price of the share per share, and the earning we are talking about is the earnings per share, the EPS, which we computed some time back. So this is kind of a multiple. It tells you that how many times of this year's earnings is the market willing to pay for a particular share. The earning is again historical, but the market would be willing to pay much more number of times the earnings because of its future potential. Again, if I were to say a P ratio of 10, for example, if you just see what does that mean, it could mean that for 1 rupee earning of the company, the market is willing to pay 10 times the price, which means at current earning level, it could take a shareholder up to 10 years to recover the amount of the price, and that is quite a big number. But then why would a prospective investor be willing to pay 10 times the current earnings? Again, the answer lies in the future prospects, which means the future earnings are not going to remain the same. The growth that the market factors into this is going to be much higher. So if I'm assuming that the company will grow by 20%, 30%, then 10 times earnings is actually going to be achieved in a much lesser time frame than actually 10 years. And that is where the element of P ratio comes in. P ratio is a very common measure which is used in the market to understand whether the stock is good or bad, whether it is undervalued or overvalued. But again, you have to factor that earnings over here is historical and the P ratio is based on the future prospects, the future potential, and not only the future potential, the market confidence in the future potential of the company. So it will be observed that growing companies will usually have a higher PE ratio, because growing companies means the potential of growth is much more, is going to be more than what the current levels are, and therefore people are willing to pay a higher number as a multiple of the earnings. But for a matured company which has already achieved a certain level of stability, the PE ratio would not be that high, because that means that growth levels have already been attained and it's more likely to be stable here on. So P is an interesting number to compare. It's a multiple that will give you some idea about the performance of the company, about the valuation of the company, and it cannot be looked at in isolation. It has to be used as a comparator with another company, either with another company or within the same industry, or to the market in general, or against the company's own historical PE. And that's where you are able to derive more sense about what the PE is all about. Also, it would not be correct to compare the PE of a company in one industry with a PE of a company with another industry, especially if those industries have different PE values. For example, a technology company usually has a higher PE because in technology industry the growth is faster. But in a utility company, in an FMCG company, generally the PE value is lower. And therefore, if you are deciding which one of the two to invest and you take a decision solely based on PE of the two companies, then that would not be correct. Another point to note here is that PE can never be negative. So if your earnings are negative, then generally the PE is not calculated. Only if the earning is positive, then you have a PE ratio, which means only for a profit making company a PE ratio makes sense. There are multiple definitions of PE. So there are two ways in which PE gets calculated. One is called a trailing PE and the other is called a forward PE. Trailing PE is calculated on the last year's earnings, which means historical earnings, and on that basis you take the PE, calculate the PE. And the forward PE is calculated on the forecasted earnings for next year. Both have their own suitability, own application. When forecasted earnings are not available, you could go for the trailing PE based on the actual historical earnings. But when, especially in a growth phase company, in a company which is undergoing a phase of growth, the trailing earnings may not be reflective or representative of the future. There, it may not make sense to go for the trailing earnings and apply some estimate of growth on that and arrive at the future earnings or a forecasted earnings. That will give you an idea of a forward PE, which will be more reliable than a trailing PE. So like most ratios, this ratio also comes with its pros and cons. Firstly, the drawbacks of a PE ratio: if the earnings are zero or negative or very small, the PE ratio will be inflated. It will not make sense, so you can't use it for comparison. PE ratio does not distinguish between permanent earnings, that is sustainable earnings, or transitory earnings, which are one-time spikes in earnings. So that does not get factored over here. And ultimately, the way the management decides, or rather the way the accounting is done for different kinds of companies, the earnings may change. The method of calculating the earnings may vary from company to company, again from industry to industry, and therefore it may not give you a uniform, reliable measure. However, the rationales why you should go for a PE, it is widely used, it is related to the stock returns, and ultimately the driver of value is your EPS. What adds to the shareholder value is the earnings that come to the bottom line every year, because that earnings in the profit and loss account get transferred to the balance sheet as part of the shareholder's equity, and PE value takes into account the earnings element, which is one of the most reliable driver of value. So with that, let's move on to the next terminology which will be useful in the next ratio, which is the EV. EV is enterprise value. Enterprise value is the value of the business, the value of the firm, value of the company. These are other ways of calling it the enterprise value. So the company has a certain value. If the company had to be sold off, what is the value of the company? Which means how much is needed to finance the company. How much of funding is needed if I were to sell off the company right now and get fresh infusion of funds? What market value will I get of the company? One way of looking at value is only from equity point of view, but then that is not enterprise value, that is equity value. And the direct measure of equity value will come from the market capitalization, which is the number of shares multiplied by the share price that is going on in the market. Enterprise value is even beyond the market value, the market capitalization, because market capitalization takes into account only equity. Enterprise value takes into account at the level of the total capital employed, which means your market capitalization plus the debt, the value of debt, which is the outstanding borrowings which are there, even those need to be repaid by a fresh investor. So the market value, market capitalization plus net debt plus minority interest if at all in the company, plus the preference share capital, which is called as preferred shares, all that will add to the enterprise value. And from that you reduce the idle cash which is lying, which is not deployed into the business. So you remove the cash and cash equivalents, and this is the formula for enterprise value. Enterprise value reflects the market value of claims that equity holders, preferred holders and debt holders have on the company. So it is the total valuation of the company as an enterprise. So with that knowledge of enterprise value, let's understand the ratios which are based on enterprise value. We have the EV divided by EBITDA, which is again a multiple. As the name suggests, that's all that is there to the ratio. Enterprise value divided by the earnings before interest, tax, depreciation and amortization. It is a multiple based ratio which tells you that if the enterprise were to be sold off, then the potential investor is willing a session of structure of P&L. The EBITDA is the cash operating profit, the operating profit before charging depreciation and amortization, which means from the EBIT, when you add back the depreciation and amortization, we get the EBITDA. So as a multiple of EBITDA, how many times is a potential shareholder willing to pay for buying of the company? So higher the EBITDA, if the enterprise value as a multiple of EBITDA is higher, then what it means is that the company will be able to get more valuation. So this is the direct valuation ratio. Then let's come to the next one, which is the total shareholder return. What does the shareholder expect as a return from the company? So the EV to EBITDA measures how much is the total company's value as a multiple of the EBITDA. And to understand better, let's go through the why EV to EBITDA is important. Since it denotes the claims of both the debt holders and the equity holders in the denominator, we have to include all the elements that the enterprise is made up of. And since the EBITDA, or even EBIT for that matter, is the profit available for both the shareholders and the debt holders, when we put it in the denominator, it gives us a higher value or a much more realistic picture rather than just taking what is important for shareholders. So the most common multiple used for commodity based companies is EV to EBITDA, because in such companies the debt levels are higher. So all the metal oriented companies, for their valuation, this is a better performance indicator in terms of their valuation. As the cost of debt can vary depending upon the geography or the size of the corporate, it forms an integral part of the valuation. And since the multiple is capital structure neutral, this multiple can be used to directly compare companies with different levels of debt. So even if a company has a debt equity ratio of 10%, or a company has a debt equity ratio of 0, or a company has a debt equity ratio of 80%, still the EV to EBITDA ratio can be used as a comparable across all different kinds of companies, irrespective of their capital structure. This multiple is often the most used multiple when it comes to M&A,